Well, under today's law, for those of you approaching the age of 73 or 75, you may be facing what's called required minimum distributions. That's right. If you have any money in an IRA or 401k, once you hit these magic ages, the government comes knocking, it's time to pay tax. And for successful retirees, many of which we work with at REAP Financial, they find themselves in a position where they really don't want to take these RMDs in many cases. Why? They can create additional taxes, more taxes on your Social Security, increase Medicare premiums, and a lot more. So today, what I want to do is talk to you about the 4 ways to optimize your required minimum distributions. Keep it right here. Good day, everybody. Chris Heerlein here, CEO of REAP Financial, host of Retire Ready TV on KXAN here in Austin, and host of Wealth Radio every Saturday, 11 a.m. on News Radio KLBJ. Thanks for making us part of your day here. If you like our channel, hit the subscribe button down below. Okay. Come age 73 or 75, you're going to be forced to take what's called a required minimum distribution. Today, we'll call it an RMD. And what's interesting is a lot of the successful families we consult with here at REAP Financial, they find themselves in a position where they may not want to take this money. They may not need it. You may have money in IRAs. You may have money in brokerage accounts, cash accounts, rental income, pensions. Whatever your situation is, oftentimes these required distributions, these RMDs, can create significant tax issues for the most successful retirees. So there's a lot of different options when it comes to your RMDs, and what I want to do is talk to you about the 4 optimal ways to take them. So here we go. Number 1 would be to measure how much you have to take and then determine if you want to take that distribution in cash or do you want to take it in kind. What I mean by that is you can take your distribution amount in the form of your stocks, your mutual funds, your ETFs, and or cash. A lot of families think, oh, I just need to cash in a certain amount of stocks in my IRA 401k, and then I need to distribute that amount, and it's got to be done before December 31st of each year. And then what do? You're going to reinvest it in a brokerage account. Maybe you're going to use it for a vacation. Maybe you're just going to put it in your cash account. But it doesn't have to just be cash. If you have investment accounts outside of your IRAs and 401ks, in many cases, you can take those mutual funds in kind, meaning you don't have to sell them. As long as the value of those positions satisfy your required distribution amount, you can then just transfer those into your brokerage account. Now, that can be an optimal strategy if you have a position that you've held a long time, or you've got positions that you firmly believe that may continue to appreciate. Obviously, if you don't need the asset, that could be a benefit as well. So be smart with how you're taking the distribution. Now, number 2 is consolidation. The way that the IRS looks at the IRAs and the distribution amount is they want a total amount due at the end of the year, and it's based on 2 things. It's based on your account balances, it's based on your age. The first year's required minimum distribution typically is going to be around 3.65% of your aggregate amounts. So consolidation comes into play with our retirees. Many of them have multiple IRAs outside of their employer plan, and they may even have an employer plan or multiple 401ks out there. You know, when you retire, you do generally want to simplify, obviously, maybe get things under one roof, one umbrella. But when it comes to your IRAs, you don't have to take the IRA out of multiple IRAs. It's not like you have to take an amount out of each one. What they do is they look at your total IRA balance aggregated, and then you can pick which IRA you want to pull from, as long as it satisfies the RMD on the year. Now, that's not true with 401ks. So if you had multiple IRAs, you can pull from one. But if you have a 401k, they're going to treat that as separate. So a required distribution would likely be due from the 401k as well. This is why a lot of successful retirees will roll their 401ks into IRAs, again, for consolidation, simplification, and to better easily calculate the required minimum distribution on the year. So that's number 2. Number 3 is what's called a qualified charitable distribution. So for any of you out there that are of age 73, 75, you're taking a required minimum distribution and you give charitably. One of the most optimal ways to give charitably is directly from your required minimum distribution. What a lot of retirees do is they take their distribution, it's all taxable as income, and then they make contributions to causes they believe in. Could be your church, could be foundations, whatever. And believe it or not, unless you itemize on your taxes, you don't get to take charitable deductions. So many people are taking their RMD, giving charitably, and still not getting a deduction. So if you give charitably at all, the first dollars we counsel families to give are directly from your IRA, because any amount that you distribute in a year that you are required to take a RMD, any amount distributed to a charity or multiple charities of your choice counts towards the total amount that you must take on the year. So for example, if you had a $20,000 required minimum distribution due on the year, and you gave $10,000 of it directly from the custodian to a charity or multiple charities. After that distribution was made to those charities, you would only have to take an additional $10,000. That would satisfy the total of $20,000. However, you would only report $10,000 of income because the qualified charitable distribution does satisfy the RMD amount and you're giving money to causes you believe in. The income is completely outside your Schedule A. It's better than a charitable deduction because it's shaving income off the bottom line. So again, if you're age 70 and a half or older, you can do what's called a qualified charitable distribution. Now, number 4, a powerful strategy may be to measure what your income is going to be, not just this year, but in years to come. What many retirees consider is taking not only their required distribution amount in a given year, but you can take more than the required distribution amount. And what that means is that by taking more this year, maybe next year and the following, that potentially means your future RMD may be smaller. The reason is, remember, your RMD amount is based on your age and the aggregate account balances. So if you're taking distributions today, that may reduce your future RMD tomorrow. Now, another question I get is, I want to get in the Roth conversion game, Chris. I got a lot of money in IRAs, a lot of money in 401ks. Can I convert my required distribution to a Roth? The answer is unfortunately not. You must take the required distribution. It will count as income, and that money cannot go into a Roth because that would be considered a contribution. You can still convert money to a Roth in a year that you have a required distribution, but the IRS states that the required distribution must be taken first before any conversion work is done. So for example, if you wanted to convert $100,000 to a Roth IRA this year and you had a $50,000 required distribution, you must take the $50,000 as a distribution first, and then you could convert an additional $100,000 from your IRAs to a Roth IRA in a given year. So that is the sequence. That is the order of business there when it comes to your conversions in an RMD year. When you're working, taxes can be rather simple. You got W-2 income, you're contributing to your 401k, but as you can see, taxes in retirement can get a lot more complicated, and I want you to get your hands on our updated retirement income planning checklist. It's 20 plus pages, full color. I want you to get your hands on it. Email me right now, retire@reapfinancial.com. That's retire@reapfinancial.com, and my team will have this great report on its way to your inbox. Until we speak again, all the best.